Capital structure is about how a company finances the growth, and this could be possible through a process of asset creation. Growth happens only through asset creation, but asset creation does not happen on its own. One of the major decisions that a financial management manager has to take is that of financing. The question is whether a company should finance the assets through raising debt or by raising equity. That is, how should the company tap the financial markets for the planned growth in assets and growth of the company. Therefore, capital structure tells us about the debt equity ratio or the mixture of debt and equity in the total capital of a firm, and this, as we have just said, is responsible for the growth in the assets of the firm. Debt and equity both have a cost, but the cost differs, and so does the risk element or the measure of risk differ in terms of debt and equity. There is a choice, therefore, that the finance manager has to undertake as to whether the amount of debt should be increased or the amount of equity should be increased for the further growth of the company. As debt involves a lower cost, but debt is supposed to be more risky. On the other hand, equity perhaps involves a lower cost, okay, and it is less risky. Therefore, there is a choice involved between the two sources of finance. There is a regular outflow in the form of interest payments, and this interest payment is known as a fixed charge, whereas equity is expensive in certain other ways although, but it is safe from the company's point of view, as the company has no legal obligation to pay dividend on the equity, particularly if the firm incurs losses. Even if it has profits, even then it is a choice of the finance managers to decide how much of dividend has to be paid, and in a certain case they may even decide not to give dividends. Therefore, the ratio known as the debt equity ratio or the capital structure of the firm is also known as the financial leverage of, that is, the leverage of using debt finance for augmenting the capital resources of the firm. Now, this affects the shareholders' earnings, and also it makes the company more risky. One of the measures of the performance of the firm, the market performance of the firm, is earnings per share, or what is popularly known as EPS. It increases with financial leverage only under favorable economic conditions, but the use of debt increases the risk of the shareholders also. Therefore, it cannot be stated that with surety that the use of leverage will increase the firm's value, that is the value of the firm. As we know, value of the firm is the price of shares multiplied by the total number of outstanding shares. The capital structure, the decision about the capital structure should be evaluated from the point of view of the impact of the capital structure on the firm's value, the value of the firm. If the capital structure can alter the value of the firm, then the company would like to have a capital structure which maximizes the value of the firm. Now, there are certain theories of capital structure. There are three things which need to be considered when we try to examine the capital structure theories. One, the proportion of debt in the total capital, which is the capital structure itself. That is the mode of financing through debt. 2, the weighted average cost of capital, and 3, the market value of the firm. So, let us now try to examine the relationship amongst these three factors. There exist two views on the relationship between capital structure and the value of the firm. One view is that this relationship is of relevance, that is, that one view is that there is a relevance of capital structure on the value of the firm, and this is known as the traditional approach or the relevance approach. Another view is the irrelevance approach of capital structure, which is known as the net operating income approach. That is, it states that the capital structure is irrelevant in determining the value of the firm. There are various theories that show that the relationship between the capital structure and value of the firm, they argue either that such a relationship exists or that the relationship does not exist, and it is that capital structure is not relevant as far as the value of the firm is concerned. Let us now consider the traditional approach. A firm should make a judicious use of both debt as well as equity to achieve a capital structure which may be called the optimum capital structure. This is the view, this is the traditional view. At this given capital structure, the overall cost of capital, which is measured by the weighted average cost of capital of the firm, would be the minimum, and the value of the firm would accordingly be the maximum. The traditional viewpoint states that the value of the firm increases with the increase in financial leverage, but up to a point only. That is, if debt increases to a certain extent, the company gets an advantage through the financial leverage, but beyond a point what happens is that this becomes detrimental to the interest of the company. Beyond this limit, any increase in the financial leverage or the debt would actually increase the weighted average cost of capital, and the value of the firm would start declining, because the investors would be aware of the cost to the company when the debt is increasing. As we have said, the debt as a source of finance involves periodic interest payments, and this is known as a fixed charge, a responsibility which has to be carried out by the company mandatorily. So, beyond this limit, any increase in the financial leverage of the company is only likely to reduce the value of the firm. The reason for the decline in the value of the firm is that the weighted average cost of capital is the replacement of expensive equity capital with low cost debt, but only up to a point. Due to the increasing financial risk of the equity holders, the cost of capital starts rising. It is widely held and asserted that the employment of debt funds is cheaper than the employment of equity funds. This assertion has the implication that the cost of debt plus the increased cost of capital together on a weighted basis will be less than the existing cost of equity before debt financing. Suppose the cost of capital for the totally equity financed company is 10%. The cost of equity and the cost of capital will be the same as the company is totally financed with equity capital. Now, if the firm replaces 50% of its equity capital with interest bearing debt, which is bearing an interest of 7%, then the cost of equity will increase slightly because of the added financial risk of the equity holders. Now, the cost of equity would increase to 11%. Weighted average cost of capital is also known as the overall cost of capital. Therefore, WACC is also denoted as KO. Similarly, the cost of equity capital is denoted as KE and the cost of debt capital is denoted as KD. And accordingly, we have two weights. One is WE, which stands for the weight of equity capital, and the other is WD, which is the weight of the debt capital. Now, considering all these factors together, we can set out an equation which is as follows. The weighted average cost of capital, or KO, is equal to KE multiplied by WE plus KD multiplied by WD. According to this formula, if we consider in the present example, we multiply 0.11 by 0.50 and add 0.07 by 0.50. That is, we have equal amounts of equity as well as debt, and we multiply these weights by the cost of capital in each case, that is the equity capital and debt capital. The overall cost of capital or the weighted average cost of capital now turns out to be 0.09, or it is 9%. The relationship between capital structure and the value of the firm could be explained through three stages under the traditional approach. The first stage is the stage of increasing value. In the first stage, a company starts moving from all equity to some amount of debt in its financing. So, the cost of equity capital KE starts to increase by a very little amount. Thus, this slight increase in the cost of equity capital is not able to set off the advantage of the lower cost of debt, which is KD. The cost of debt also remains constant as the market perceives the debt as a reasonable policy. Consequently, the overall cost of capital, or WACC, goes down, and thus the value of the firm increases. The second stage, this is also known as the optimum value of the debt equity, or optimum value of the firm for the optimum debt equity structure or the capital structure. As the company keeps increasing debt financing, there comes a point which gives the firm an optimum value of the firm. In this case, any further increase in the debt may cause the cost of equity to increase by such an amount which completely offsets the advantage of having a lower cost due to debt. The result of this is that the weighted average cost of capital shows no change and therefore attains the minimum level, and at this point the value of the firm attains the maximum level. So, such a point or range shows that the maximum value of the firm is achieved when we have the lowest weighted average cost of capital. At this stage, the firm achieves the optimum debt equity ratio or the optimum capital structure. After this point, we arrive at the third stage or stage 3. In the third stage, there is a decreasing value of the firm. After reaching the optimum level, any increase in the debt results into a very large increase in the cost of equity as required by the shareholders for the increased financial risk. Such a large increase in the cost of equity is not able to offset the advantage of a low cost of debt. Moreover, the cost of debt also increases, as a result of which the weighted average cost of capital increases further, and then the value of the firm goes down. So, initially the value of the firm increases, it goes up to an optimal point, and at that point we have the optimal capital structure, and thereafter the value of the firm keeps going down. Thus, the 3 stages explained above show that the value of the firm and the weighted average cost of capital do depend upon the leverage of the firm or the capital structure. In the initial phase, an increase in the leverage results into a decline in the weighted average cost of capital due to a comparative advantage of the low cost debt. On further increasing the leverage, the weighted average cost of capital reaches its minimum point, beyond which it starts increasing. Therefore, the weighted average cost of capital attains a U-shaped curve, which implies there exists a point at which the overall cost of capital or the weighted average cost of capital K0 is the minimum, and at this point the value of the firm is the maximum. This point is known as the optimal debt equity ratio or the optimal capital structure.
After studying this module, we shall be able to elaborate the relevance of capital structure in determining the value of a firm, explain traditional approach of capital structure, highlight how to make the judicious use of debt and equity in capital structure for maximizing firm's value and minimizing weighted average cost of capital, analyze the 3-stage relationship between capital structure and value of the firm, understand net operating income approach in capital structure. First of all, we will discuss the meaning of capital structure. Capital structure is the debt-equity mix in the total capital of the company. Debt and equity differ in cost and risk. Debt involves less cost, but it is very risky security because of regular interest payment, whereas equity are expensive securities, but these are safe securities from company's point of view, as company has no legal obligation to pay dividend to equity shareholders if it is running in loss. In theory, there exist two views on the relationship between capital structure and value of firm: traditional approach and the net operating income approach. The first view is based on relevance of capital structure, that is, capital structure affects the firm's value, and the net operating income approach is based on the irrelevance of capital structure, that is, capital structure is irrelevant in determining the value of firm. First of all, we shall discuss the relevance of capital structure in valuation of the firm, that is, the traditional approach. As per this approach, a change in capital structure affects the cost of equity, due to which the overall cost of capital changes. Thus, the value of the firm also changes in response to changes in the cost of capital. A firm should make judicious use of both the debt and the equity in its capital so as to have an optimal capital structure. At this point of capital structure, value of firm is maximum and overall cost of capital is minimum. Let us now discuss the three stages in traditional approach explaining relationship between capital structure and value of the firm. In the first stage, as company starts moving from all equity to debt financing, the cost of equity starts increasing by a very less amount. But this increase in cost is not able to set off the advantage of low cost of debt. As a result, weighted average cost of capital goes down and value of firm increases. Second is optimum value stage. In this stage, any further increase in debt causes the cost of equity to increase by such an amount which completely offsets the advantage of low cost debt. Thus, weighted average cost of capital reaches at its minimum point and firm attains its maximum value at this point. Hence, optimum debt equity ratio is achieved at this stage. Therefore, weighted average cost of capital gets a U-shaped curve, which implies that there exists a point where the overall cost of capital is minimum and the value of the firm is maximum. Third is decreasing value stage. After reaching the optimum level, any increase in debt will cause the cost of equity to increase by a very large amount because of increased financial risk. Such increase is not able to offset the advantage of low cost debt. At this stage, cost of debt also increases. As a result, weighted average cost of capital increases and value of firm goes down.
Now let us discuss the working of the traditional approach with the help of the hypothetical example that we have, where we have three options. One option or one financing decision is that the firm goes with 100% equity, with the cost of equity being 16% and 30% debt, with the cost of debt being 10% and the cost of equity being 17%. This is the second option. And the third alternative is that we have 50% debt and with 12% as the cost of debt and 20% as the cost of equity. After working out the calculations as shown in the table, we can see that the value of the firm increases and the overall cost of capital goes down, and with an increase in the debt, but this happens only up to a certain limit, that is, the limit is 30% of debt. But if you employ more than 30% of debt, the value of the firm goes down and the overall cost of capital increases. Therefore, the firm should make a judicious use of both debt and equity so as to maximize the value of the firm, which in other words means to minimize the overall cost of capital.
Let us see how the overall cost of capital and the value of the firm is independent of its capital structure with the help of an example. Suppose the earnings before interest and taxes is rupees 2 lakhs. The overall cost of capital is 10% and there are three options of debt mix, that is 30%, 40% and 50%. After working out the calculations as shown in the table, we can see that if we increase the proportion of debt in total capital, value of equity goes down and cost of equity goes up because of less profit available for equity shareholders, and hence it increases the risk of shareholders. The second approach of capital structure is net operating income approach. This approach is opposite to the net income approach. According to this approach, the firm's value depends upon EBIT and the overall cost of capital. We have assumed that overall cost of capital is constant and depends upon business risk, which is assumed to be constant. Cost of debt is also taken as constant. However, cost of equity increases with increase in leverage because of increase in risk of shareholders, as can be seen here. Thus, we can say that financing mix or leverage is irrelevant in determining firm's value.
Let us now see how the overall cost of capital and the value of the firm are independent of its capital structure. This is according to the irrelevance theories and not according to the traditional theory. Let us understand this with the help of an example. Suppose the EBIT is of rupees 2,200,000 rupees, and the overall cost of capital is 10%, and where there are three options of the debt mix, that is 30%, 40% and 50% respectively. We can see that if we increase the proportion of debt in the total capital, the value of equity goes down and the cost of equity goes up, because the less profit available for equity shareholders does not satisfy them, and hence there is an increase in the risk to the shareholders. Now, let us take up this example for the case where the debt is 30%. EBIT is equal to rupees 2 lakhs. The overall cost of capital KO is 10%. The value of the firm is 20 lakhs. The value of 6% debt is 3 lakhs, and the value of equity is 17 lakhs. The interest on the debt is 18,000, and the net profit for equity happens to be 1,82,000 rupees. The cost of equity capital is 10.7, and now let us take up the case of 40% debt. EBIT is equal to 2 lakhs. The overall cost of capital is 10%. The value of the firm is 20 lakhs. The 6% debt is 4 lakhs. The value according to 6% debt is 4 lakhs. The value of equity is 16 lakhs, and the interest on debt is 24,000. The net profit for equity is 1,76,000, and hence the cost of equity capital is 11%. Finally, we take up the case of 50% debt. EBIT is equal to 2 lakhs. The overall cost of capital still remains 10%. The value of the firm is 20 lakhs. The value of 6% debt is 5 lakhs. The value of equity is 15 lakhs, and the interest on debt is 30,000. The net profit for the equity is 1,70,000, and the cost of equity becomes 11.33. So, the cost of equity capital KE are respectively 10.7, 11 and 11.33, and this can be verified for different proportions of debt by calculating the weighted average cost of capital as follows. For 30% debt, KO is equal to 0.107 multiplied by 17 lakhs divided by 20 lakhs plus 0.6 multiplied by 3 lakhs divided by 20 lakhs, which is equal to 0.10 or 10%. Now, for 40% debt, the overall cost of capital is equal to 0.11 multiplied by 16 lakhs divided by 20 lakhs plus 0.06 multiplied by 4 lakhs divided by 20 lakhs, which once again is equal to 0.10 or 10%. For 50% debt, the overall cost of capital K0 is equal to 0.1133 multiplied by 15 lakhs divided by 20 lakhs plus 0.06 multiplied by 5 lakhs divided by 20 lakhs, which once again is equal to 0.10 or 10%. Therefore, the overall cost of capital remains the same. These calculations of weighted average cost of capital testify that the benefit of employment of more and more of debt in the capital structure is offset by the increase in the equity capitalization rate, that is KE.
Let us see how the overall cost of capital and the value of the firm is independent of its capital structure with the help of an example. Suppose the earnings before interest and taxes is rupees 2 lakhs. The overall cost of capital is 10% and there are three options of debt mix, that is 30%, 40% and 50%. After working out the calculations as shown in the table, we can see that if we increase the proportion of debt in total capital, value of equity goes down and cost of equity goes up because of less profit available for equity shareholders, and hence it increases the risk of.
Now let us summarize what we have studied in this module. There are various approaches about the capital structure. There are different theories and there are approaches. Some of these approaches are known as relevance approach and the others are known as irrelevance approach. Those which contribute to the relevance approach state that the capital structure is relevant and it affects the value of the firm. And the irrelevance theories, they state that the capital structure, whether it be high or low, whether the leverage be high or low, is irrelevant as far as the value of the firm is concerned. As per the traditional approach, a firm should make efficient use of both debt and equity to achieve the optimum structure. The optimum capital structure is one at which the firm's value is maximized and the weighted average of cost of capital is minimized. While there is a choice involved between debt and equity, there is a rational way of deciding about how one should go about, how a firm should go about increasing the debt and take advantage of this in terms of a lower weighted average cost of capital, and should in the process attempt to increase the value of the firm. So, the relationship between the capital structure and the weighted average cost of capital and the value of the firm exists, and this is displayed in terms of three stages: the increasing value stage, the optimum value stage and the decreasing value stage. The optimum value stage is one in which the cost of capital, the overall cost of capital is the minimum and the value of the firm is the maximum, and this is known as the optimum leverage ratio or the optimum capital structure. The cost of capital under the traditional approach is reflected, or it is represented by a U-shaped cost curve, because the overall cost of capital KO declines up to a point and then it starts increasing like a U shape. The cost of capital according to the net operating income approach, signifies that the market value of the firm depends upon the net operating profit, that is the EBIT, and the overall cost of capital WACC, the weighted average cost of capital. So, the cost of capital under the NOI approach is a straight line, it is a horizontal line, and therefore, it talks about the irrelevance. Now, overall conclusion is that the capital structure of a company is the mix of debt and equity in the company's sources of finance, the mode of financing growth, and the ratio of the debt in the capital structure is also known as financial leverage. Some companies prefer to have more of debt while others prefer to have more of equity, but let us not forget that both debt as well as equity have some cost to the company. Therefore, while deciding upon the capital structure, a company has to consider the weighted average cost of capital, which is WACC or KO, and the ultimate goal of the company is to maximize the value of the firm and the profits of the firm. There exist two views about this relationship between capital structure and value of the firm. One view is about the relevance of capital structure, which, as we said, is the traditional approach, where it says that the capital structure does affect the value of the firm, and the other view is the irrelevance approach, where the capital structure or the does not affect the value of the firm. This is known as the net operating income approach, and here we can show how the capital structure does not affect the value of the firm. There are various other theories as well, and the net operating income approach about capital structure believes that the value of the firm is not affected by changes in the debt component. It assumes that the benefit that a firm derives by infusion of debt is negated by the simultaneous increase in the required rate of return of the equity shareholders. With the risk in the debt, the risk associated with the firm, mainly the risk is in the form of bankruptcy risk. This risk also increases, and such a risk perception increases the expectations of the equity holders. The main points of net operating income approach are the following: that the investor sees the firm as a whole and thus capitalizes the total earnings of the firm to find out the value of the firm. The overall cost of capital of the firm is constant and depends upon the business risk, which is also assumed to be unchanged. The cost of debt, KD, is also taken to be constant. Thus, the use of more and more of debt in the capital structure increases the share risk to the shareholders, and thus results in an increase in the cost of equity, and thus the increase in the cost of equity, it completely offsets the benefit from the reduced cost of debt as we employ more and more of debt. There is in this framework there is no it is assumed that there are no taxes. Therefore, to conclude, capital structure, as we have seen, is about the debt equity mix in financing the assets of a firm. Debt and equity both have a cost. Therefore, the question is not about how much of debt and how much of equity, but the question is about seeing how much the total or the overall cost to the financing is in terms of the weighted average cost of capital. There are different theories. There is a traditional approach and there is a non-traditional approach or the irrelevance approach. Therefore, in conclusion, we can say that both approaches have a relevance, and therefore capital structure could both be stated as being relevant as well as not being relevant for the value of the firm.